This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our trade alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
Well, good evening, everyone. This is AJ Monty, Chief Market Strategist with the Market Guys, and I'd like to welcome you to this monthly open house Q&A. If you're brand new to this session, then welcome, but make sure you share this with everyone. I have some pretty exciting news to be sharing in a little while here. And before we get going, I just want to give, especially the newbies, a lay of the land and how we go about this. Usually what I do is I'll go over the major markets in a similar fashion to the way my weekly market reports go out. And then as we're taking questions and moving through the charts, I will take stock symbols from the audience and I'll analyze those according to the technical signals. And I will also point out support and resistance areas so that you could use this more or less as a tool to manage risk. And as we progress through this trading year, I would strongly recommend that each and every one of you focus on risk management, because there are no guarantees with regard to price action. There is, however, one guarantee that I can make you, and that is if you allow the market to take money from you, guess what? It will. Most definitely it will. So again, risk management is the key. This is the Dow Jones Industrial Average ETF, ticker symbol DIA. And this is more or less a 1/100th of the Dow Jones Industrial Average itself. So it's an exchange traded fund that you can trade options on it, especially. And it's something that has been following the technical signals quite closely. You can see here as I zoom in, this is the line that I drew last Friday saying that I would expect the market to drop. And this right here, this big red candle, is a bearish engulfing pattern. Now, interestingly enough, the Dow rallied over 150 points today, but that candle is still showing a lower high and a lower low. So far in the first trading day of the week, this market is following my forecast line, at least for now. Now, another thing that you might want to notice is the stochastics down here is more or less starting to hinge sideways. It was moving lower on Friday, and because we closed closer to the high today on this candle, this stochastic is starting to hinge up. On the other side of the equation here with regard to oscillators, let me condense this a little bit. You can see that the CCI, which is the Commodity Channel Index, is still going down. So we have mixed signals today. We have the price more or less continuing with lower lows, lower highs, but we have a drop in volume. We have still a gap above the market. There's a lot of different signals here. I don't see, especially if you're following the trading checklist that I put out, there is the evidence is not weighing in on just one side of the market. It is very, very mixed. So when I see that, if you're playing the market short and you think it's going to go lower, then put buy stops in. If you're playing the market on the long side expecting a bounce, then I would, again, strongly recommend you put sell stops in and probably put them in below the lows on the diamonds there. Okay, so that's DIA. We look at the Qs, which more or less represents the tech sector. This was slightly different forecast that I put out than the other markets. I said on Monday, I said we would most likely go up to test resistance here. You see that? Let me zoom in just a little bit more. See this little red line that I drew, and I said we would most likely go up, test that resistance, and then start to come back down. Now, again, this is not showing a lower low and a lower high. So it is different than what we saw on the diamonds. And like I said last week, these markets don't always trade in sync. They don't all move up and they don't all move down. So a lot of them will move opposite, especially the Russell 2000, which is a small cap index. A lot of times the Russell 2000 has a mind of its own. And like the tech sector, as you're seeing here, tech stocks are showing a little bit stronger. And so this candle today is a bullish engulfing pattern, believe it or not. You see this long green body is engulfing the previous red body from Friday. All right, so we still could go a little bit higher, test that resistance and come back down. But again, if you're playing the tech sector from the long side, again, strongly recommend that you put in stops and use stops. All right, let me get rid of that line there. I don't want any marks on here because I use this forecast each and every week. I record these, I put them on YouTube, and they're available to the public. There was a comment, if you pulled this from YouTube and you didn't get it via email from us directly, there was a comment, it was a code name, so I don't know who the person's actual name is, but they were stating that they can't believe that my market reports are free. And I will do my very best to keep them free. I want to educate the public, especially on technical signals and how to use them as risk management tools. And so, spread the word. That's the only thing that I ask when you're watching these on YouTube, and you have the ability to hit the share button, please do it. Hit the like button, hit the subscribe button. I have not been the social media promoter like I probably should have. I almost assume that if I'm providing good value for people, they're going to naturally share it. But nowadays, I guess I have to ask people to share it. And the reason I ask you to share it is twofold. Not only to help those who you care about most, but when all of a sudden you have more people following the technical signals as a risk management tool, or even as a forecasting tool, the more people we have following the signals, the more accurate the signals become. Yes, call it whatever you want. Call it self-fulfilling prophecy. Call it, crowd mentality, mass movement, whatever. But the same thing applies to analysts. If you're looking at ABC stock and the analyst who has a very large audience is listening to this analyst upgrade the stock, guess what people are going to do? They're going to buy the stock, and that analyst has just pushed the market higher, right? The only difference is that analyst is not going to tell you, hey, I think you should sell the position now that it's up. Or, oops, my forecast was wrong, I think you should get out. No. However, the charts will. The charts will give you those boundaries. So if we're seeing a bullish engulfing pattern here, and there's an 80% chance the price will go higher tomorrow, then you have to play it as a defensive move that, okay, I'll go on the long side, but I have to put a stop below the market. And I'll put the stop maybe below today's low or Friday's low and give it a little room. And that's where charts become the best tool for us, not just to see where the money is coming from or which direction the money is going to. It gives us the exit plan as well. So there's the cues. All right, let's go to the Russell 2000. I was talking about that. The Russell 2000 also showed a bullish engulfing pattern. Now, interesting, because remember I said these are conflicting signals that we're getting. We have a bullish engulfing pattern with a fairly long shadow under the candle, but we have a lower high and a lower low from Friday. So technically, this short-term downward leg is still intact, even though that's an engulfing pattern, even though it has a long shadow. You have to be very careful because that's a mixed signal. When I'm looking at the technical signals. I look at the price, the type of candle it is. I usually look at volume. The Russell 2000 here, this index is not showing volume, but if it's an individual stock, I look at the volume, and then I look at the oscillators afterwards. So now you have, interestingly enough, you have a bullish engulfing pattern. Stochastics is moving up. The CCI is not moving up yet, at least not yet. So we have to keep an eye on that as well. So, again, mixed signals on the Russell 2000. So you have to be, again, very, very defensive. Let's look at the SPY, which is the spiders. Very different than what we've just seen. This is not an engulfing pattern whatsoever. We have a lower high here. Let me zoom in just one more and explain to you what this signal is. We have a lower high, but we have a higher low. Can anyone who's ever studied charts tell me what that means when you have a movement lower? So we have lower lows here over the past 3 days. Today we have a higher low. Can anyone tell me what that signal represents when you have a lower high but a higher low? It's not a harami, all right? Let's see, who wants to take a stab at that? We have a lot of people on this call tonight. Thank you very much for following. All right, no one's, no, well, it is a spinning top, Todd. That would be a small body candle, almost equal shadows. All right, this is called the half signal. A half signal is when you have a downward leg and the lower high tells us the sellers are still in place, but the higher low is a half signal. If we had a lower low, then that means the downward trend is still intact. Half signals generally occur at tops or bottoms. It's usually like a beginning stages of a pivot point. All right, so keep that in mind. Again, it's a mixed signal. Now look, Friday we closed below the 20-period moving average. Today on the spiders we closed above the 20-period moving average. And the volume is not that high. In fact, we're just about maybe a little bit over half of the volume that we had on Friday. So again, it's not a convincing sign that the buyers are coming in, but it's also not a convincing sign that the sellers are taking over. So according to what Mike is saying, it's a sign of indecision. Absolutely, it is. That kind of a signal is very similar to what you would see in a doji or some type of a neutral signal like a spinning top. Okay, so that is let me see, Todd said something. This is a half signal because it's half the size of the previous candle. No, that's not what I mean, Todd. Let me see if I can find another half signal. Hold on. Where's the half signal? It's hard to see. I don't see any here. Looking. No, I don't see any half signals here. They don't happen all that often. Let me see. No, I don't see any half signals. It's again, if you had, now look, here's a red candle. Here's a half signal. Watch. Here's a lower high, but a higher low. Half signal. Here's a lower high on this green candle, lower high, lower low. That's not a half signal. That's a down candle. Here we have a lower low, higher high. All right? That is an engulfing pattern, and then the half signal is a lower high, higher low. So it's when I'm trying to find the words here to get it's when the highs and the lows don't necessarily match in sequence. So one of them is going to be out of sorts, so to speak. All right. So that is another sign of confusion. Again, all that means is that if you have a position, either long or short, there's no convincing evidence that we're going to move hard either way tomorrow. And in fact, I was mentioning this to one of my coaching clients. His name is Mike. He's in California, and I referred to the news. How many of you, just by show of hands here, let me see, how many of you by show of hands, ready? 1, 2, 3, get ready. How many of you by a show of hands are really getting sick and tired of all the negative news every time you turn on television? Let's see. Bam, bam, bam. Look at those hands go up. Bam, bam, bam. Right? I'm telling you right now, I don't put on regular television. I don't watch the news. The only news that I look for is market-related news, anything that might move the market. And I'm getting that from the web. I'm not getting it from television. You can put your hands down now. Okay, so that way, in case I ask another question, I'll be able to bring that. Okay, Dr. Billy Price in the house. Thank you, Billy. You could lower your hand too. Okay, now let me tell you what's going on. This world has gotten so politically charged that the news. My personal opinion is coming out here right now. I don't know what to believe anymore as truth. I'm really, we're getting so bombarded by different views of what's going on in the world that I really don't know what's happening as far as what's truth and what's inaccurate or mistruths, right? You can even call them lies. I don't know. I don't know what to believe. Now, as a result, here's my view on how this is going to affect the market. I believe that investors and people in the general population are becoming desensitized to this barrage of negative news, anything from pandemic to lawlessness in the streets to police, quitting and being disbanded. People are becoming desensitized. Now, here's why. Cortisol is a hormone that gets released when you constantly expose yourself to negativity, especially news. And what happens is the news is adding lots of stress to people's lives. So they're making decisions. I'm going to turn it off in my head for a while. Even if they're just taking a news vacation, they're pulling back and they're saying, I got to get my life together. I got to feel better about what's going on. They're spending more time with their families, especially Father's last weekend. Happy Father's Day to all the fathers. They're spending time with their family. But interestingly enough, the market is not becoming, I guess you could say, jolted as much as it was even 3 months ago. Right? You notice negative news is coming out all about this corona thing, every which way you look at it. But the market is not jolted by this news anymore. That's a sign to me that the investors are focusing on price. They're focusing on the companies. They're being smart. They're being proactive. They're putting their money where they think the growth is going to be. Now, for us as traders, we have to pay very close attention to the charts. We have to. Here's why. When Charles Dow in the early 1900s, when Charles Dow created Dow theory, and I said this a while ago, he created the Dow Jones Industrial Average to forecast the U.S. economy. He didn't create the Dow Jones Industrial Average to be used the way we're using it as a technical tool for forecasting and managing risk. No, he was using the Dow as a leading indicator to forecast economic growth. You see? But what happened, the evolution of technical analysis and the principles, which we call the Dow tenets, one of the greatest things about Dow theory is that one of the tenets says that the charts discount all the news. In other words, the news is already in the price. There's nothing that you can introduce to the market tomorrow that would have affected today's price any more than the price has already been affected. So, and what this is basically is you have millions of people putting their money into the market, whether it be for retirement, 401k, trading, whatever, option traders. They're putting their money in the market. And collectively, as a group, they're making a decision as to where fair value should be. And that's why the 20-period moving average is so important. When you see that blue line right here, see how I'm highlighting this? That 20-period moving average is extremely important. And right now, again, as I zoom back in there, we closed almost exactly on that, just a hair over that 20-period moving average. And Friday, we closed just a hair below it. So the market right now is fairly balanced, and according to investors, again, as the masses reacted and voted with their money, right now the S&P is at what I would call fair value, which is that 20-period moving average. The opportunities for trading occur when we have a divergence from the moving average. You see, like we see here. When we see wide divergences above the moving average, those are opportunities for us to take short positions. When we see wide divergences below the moving averages, those are opportunities for us to take long positions. And we react on those long positions the way, like back here, you see the CCI crossed above that green line. That was a buy signal. So here we hit a low. And right on this day and right after that, we had a buy signal. Look, you would have made money right back to the moving average as the price snapped back to it. So for now, as the markets are at the 20-period moving average, for the most part, the indices are at the moving averages, option traders are having a field day. Option traders are having a field day. We have people that are on tonight that have been following me for years, and we even have mentor students and coaching clients of mine that are listening right now that can tell you that option traders are having a field day. When the markets are stuck within ranges, there's lots of things that you can do in the option markets to make money. Now, I'm not telling you tomorrow, if you've never traded an option, go start trading options. No, don't do that. I don't work for Robinhood, okay? I'm not telling you go and leverage your money to the hilt. I'm telling you, take your time, learn options, learn how to maneuver in all conditions of the market, whether they be up markets, down markets, volatile markets, sideways markets, or range-bound markets. Each one of those types of markets gives us opportunity to be able to make money, especially through a little thing called time erosion. Okay, so keep that in mind. Now, the last thing I'm going to look at right here is the VIX, right? The volatility index. Interesting here. This is something you don't see very often. Here, Friday, I called out the bullish engulfing pattern. There it is. Big green candle engulfs the previous red candle. Now, follow me. This red candle right here, that is from the 18th of June. That was a bearish engulfing pattern. It was then followed by a bullish engulfing pattern, which today is followed by another bearish engulfing pattern. I don't remember if I've ever seen that happen. I just don't recall. Maybe I did and I just overlooked it, but I do not recall any 3-day pattern where we went from bearish engulfing to bullish engulfing back to bearish engulfing in 3 days. I don't ever remember that happening. Now, here's what you do. When you see something like that, there is a technical analysis concept called the summation principle. When you have back-to-back confusing signals, what you do is you take the 3 or even 4 days, you take the opening from here and add it to the closing here, and treat that as though it was one candle. Now, if I were to do that, if the opening was right here at the bottom of this candle here, and the close is at the bottom of this candle here, then that would be a red candle over the last 4 days. So if you're using the summation principle, this is still a bearish candle, all right? So what does that mean? It means I could possibly be wrong on the VIX coming into the end of the week. The VIX could actually go lower and fill this gap, which would be a gap support level. Now, if the VIX is bearish, or if it does go down by the end of this week and doesn't go up like I think it will, then you need to understand that the VIX is inversely related to the S&P. Now, if a dropping VIX is bullish for the S&P, then the long traders are going to have a good week. But again, I don't know. At this particular point, I want you to know my positions, for the most part, are still long. But I have very close stops put in place, and most of my positions are spread. So in other words, going back to the option strategy, if the market goes down and doesn't go up like I think it could according to my spreads, I don't want to sound like I'm talking with a forked tongue here. I have long calendar spreads, long diagonal calendar spreads in my personal account, okay? The way I have it set up is if the market goes down, I could still make money by rolling positions and collecting premium. Again, I don't want to get complicated, but long call diagonal calendar spread, you could still make money if the market goes against you, depending on what you do to manipulate the spread. Again, another reason why people need to look, in my opinion, I think they need to look at least trading spreads. Not directional, but time spreads in this particular market. Okay, so there's the VIX. Again, confusing, right? We have a bearish engulfing pattern with the stochastics going lower. The CCI is still going lower. If it crosses below that black line, guess what? That's the momentum line. So this is the first time in a long time where we don't have all the signals stacking up perfectly on one side or the other. Right? We've got a lot of mixed signals, and that's something you have to pay attention to. Okay, now, welcome, Laura. I don't know if you put on that spread that you text me. Laura's one of our coaching clients, and so I don't know. Laura, you could send me a direct text to let me know what you did today. But let me make the big announcement, and then I'm going to get into I'm going to get into some individual stock analysis. All right. Now, there's a fellow on here, Dominic, wave your hand to me, make sure you hear me. On here, we have Dominic Boyle. Dominic works for a company called Market Rebellion. All right, Dominic is on. He's hearing me. Now, here's the big announcement. John Nigerian is a good friend of mine. I don't know how many of you watch the show Fast Money on CNBC, where John Nigerian and his brother Pete are really the personalities of that particular show. And John was actually one of my first guests on my PBS show, Wealth and Wisdom, long before he had his show. And so I've been in touch with John for a very long time. And John and Pete and Dirk Mueller are the three partners of a company called Market Rebellion. Now, what I'm going to be doing is I'm moving my alert service to Market Rebellion. It's still going to be called, from what we know now, it's still going to be called the Option Oracle and the Equity Oracle. We're still working on getting that legal paperwork outlined, but I don't think the names are going to change. But we are building Market Rebels. Market Rebels, it doesn't mean you're wearing a bandana and carrying a special flag of any sorts. No, we are educating the general public to learn how to read charts, technical analysis, trade options, and do it effectively and efficiently. And my new arrangement, I would even call it a partnership, a joint partnership with this new service, is going to be very exciting because we're going to be doing more webinars. We're going to be doing live open houses. We're going to be, Pete and I have talked about doing rapid fire stock analysis on his segment that he has a web-based television show he's putting together. Whether or not I'll be on Fast Money, I don't know. That's not my main goal, but the goal is to build the audience and build it big. Now, I mentioned Dominic Boyle. Dominic is working with me and his sales team to build the audience. So remember that name, write that name, Dominic Boyle, And when you start to see future communications from me, you call Market Rebellion, talk to Dominic. All right, he and I are working hand in hand to really build this out big. Okay, so make sure you stay in touch, and I will be making more announcements about that. Now, for those of you who have subscribed or already are subscribers or members of my Trade Alert service, you're going to wind up, in the end, getting a big discount because I've agreed to lower the price. Once we get this, the ink dry on the paper, we're going to lower the price and make it an annual membership instead of the monthly, the monthly way we're doing it. It's a little bit more convenient that way. You get big discounts, and I don't want that to sound salesy. I'm just making the announcement. Okay, so this is really exciting stuff. We are also going to be doing a virtual event. We last year we did a live event in Las Vegas. That was a couple of days long. It was really great. But because of this pandemic thing that's going on, we're going to be making more announcements about that and selling tickets for a virtual online event where we are going to be broadcasting live from our respective offices, and then you will be able to interact with the speakers that way. So again, stay tuned, lots are going on. And so Dominic, if you have anything you want me to add to that, just text me and oh, my phone's off. Okay, send it in the message here, send in the message box, and I'll make sure that we get that out. Okay, now here's where we get into rapid fire stock analysis. Now, okay, Dominic's email is dominic.boyle, B-O-Y-L-E, at marketrebellion.com. He just sent that over to me. So it's dominic.boyle at marketrebellion.com. Any questions about that, just talk to Dominic, email him, and he'll get back with you. Okay, now, Roberta, welcome. Okay, Roberta, I'm going to have Francis. I think I see one there. If you can, retype your stock symbols because we have a lot of information coming in and it's getting washed off my screen there. So let's go and try to get these stock symbols. Let me try to open up this window a little bit more. Okay, let's see if I can get this. Hold on. Hopefully I still have everyone. All right. So let's start with Francis. Francis is asking me to look at KMX holding puts, July 17th, 87.50. All right, first of all, Francis, I hate, me personally, I hate buying front month options. You know why? Because that time decay thing. I'm usually the guy selling the front month options. All right, now, here's the thing. Right away, you tell me that you're holding puts for July at the 87.50 strike, which are out of the money, and I see a bullish harami right there. You see this? So you got to be really careful with that one. I don't know if you have a profit built into that, and you also had the January 75s. All right, so you got the puts. All right, you're upside down on that one. If you told me you had the January 75 calls, and you were short the 87.5 calls, I'd love it, right, man, because that's bullish. But you got it opposite of what the signals are saying right now. So this is a bullish harami. The price has dropped on much lower volume here now. That's telling us the sellers are slowing down. The stochastics is still going down, but look at that CCI. That CCI is much more sensitive than the stochastic. So if the CCI goes back up over that black line, that's the momentum line. We could see higher prices in KMX. So be really, really careful with that one. Okay, Roberta is thinking about buying BDX. Let's take a look at that. BDX. Now, that one doesn't look that bad, Roberta. All right, now again, I was still getting mixed signals from the overall markets, and there are still mixed signals on this as well. So let me take it one step at a time, as though you have the trading checklist in front of you. Let's see if I have the trading checklist here. Let me see if I open this up for everybody. Okay. All right. For those of you that do not have a copy of my trading checklist, stand by. You'll be able to do a screenshot here, hopefully, as it opens up. Let's see if it opens. Did it open up? No, it didn't open yet. All right, let me open this up. And let's see, there it is. Okay. Let's see if I can make this a little bit bigger and get the full screen in here. Okay. All right. For those that do not have the trading checklist, go ahead and get a screen grab now. I'm going to freeze my cursor so I don't get it. Just for those that have a Mac computer, you can do, I think it's Shift Command and the 4 key. It'll capture a screenshot of this. For those that have a PC, I do believe there's a print screen or a print capture button on your keypad. And if you're not doing any of that, then just go back to the recording and you can just copy this trading checklist. Now, again, when I have the trading checklist, Roberta, this is specifically to you, I look at the type of candle first. Then I look at the supporting volume to see if the volume is supporting that particular candle. Right now, let's look at that. We have, we have what is very close to be a hammer pattern. A hammer is a small body candle with a shadow that's 2 to 2.5 times the length of the body. So that is about 2 times the length of the body. And that long shadow underneath tells us that the sellers tried to push it down and keep it down, but the buyers came back and fought back. So that would be a bullish candle. Now, look at the overall look at it's a very slight downward leg that we had from here on the 18th. It's the 17th, the 16th, 17th, 18th, 19th, and then we have today, right? So it's a very slight downward leg, and today the volume is about half of what it was on Friday, right? So that tells us the sellers are slowing down. Is that bullish or bearish? That's bullish. So far, we have a check mark of the candle. It's a hammer pattern, like I said, right? It's on lower volume. That would be bullish. Now we have to look at the 20-period moving average. What is it? There's not a wide divergence between that candle and the moving average. So you can't say that's extremely bullish. So that's going to be neutral, right? All right, no, there's virtually or almost no divergence from that moving average. It's almost at fair value. Gaps, are there gaps above the market? Yes, there are. There's a gap all the way up here. Now that price gap is going to act as a magnet, Roberta. So if you're deciding to take a long position and you think it's going to go higher, understand that before you get to that gap above the market, you're going to be hitting resistance here, right? And if the market over the next week or 2 weeks starts to storm up, even in this angle that I drew right here, then that price is going to start moving away from that moving average. So in other words, I do not think that price is going to get right up to the gap anytime soon. It's going to take a while. If it does fill, it's not going to do it next week. So you have to be really careful, all right? Now you say, now you're talking about the company Becton Dickinson, and that there will be an increased need for needles when vaccine is produced. Be careful, be careful, be careful not to fall in love with the company or the product that company produces. I've seen too many people get hurt because they're so attached to the product of the company. Roberta, if you're going to take a long position, follow the technical signals, put your stop below a key support level, and then manage risk. Okay? David Silver, welcome. David's a longtime follower. I love talking to David because he always has good questions and he has good stocks. Look at MRK. This is Merck, right? This is a pharmaceutical company. And his comment here, Merck for naked put sale. I don't like doing anything naked. That sounds right. I don't like doing anything naked in the option market, David. Selling a naked put is highly risky. So if you're trying to sell the 75 puts, understand that that 75 put would be right here. Can that stock drop before expiration? It sure can. However, right now, if you look, this is again, some mixed signals. This is a smaller body candle, but you had a long shadow, not necessarily a hammer here, because a hammer is usually found at the end of a downward leg, but that long shadow does make it bullish, all right? There is somewhat of a divergence from that moving average. I don't see any gaps above the market, but I do see resistance up top. Now, here's what could happen, David, if you're not careful. If you sell the 75 put, right, and you have a stop at 73, then this is what happens, right? If you're selling the 75 put and it goes to 73.01 and stays there, guess what? You're going to wind up long the stock at 75, less whatever you took in as a credit. So that support level, though, is going to be critical for you. And there's still about 3 weeks left till expiration, and anything can happen with a stock like Merck, believe me. Here's another little tidbit, all right, David. Keep an eye on the PPH. The PPH is the pharmaceutical trust. It's pharmaceutical ETF. So you can see that this particular ETF is above the 20-period moving average. But if this ETF starts going down to fill this gap, it could bring Merck down with it, right? Because you got Merck, you got Pfizer, you got Eli Lilly, you got McKesson, you got them all in this ETF right here. And so this could very well be one of your leading indicators to manage risk. Keep an eye on that one, and hopefully that'll help you. All right, Mike is looking at XLK long at 102.04. So let's see, XLK, why didn't that go? Okay, hold on, I gotta get that in there. XLK is right there. And you are long at 102.04. Now here's the question. We looked at this before, we had fan lines in there. Mike, let me ask you, where's your stop? All right, because here, remember with that trading checklist, you have a bearish engulfing pattern on Friday. It was not overrun by this green candle because we still have a lower high and a higher low. So here's the half signal right there, lower high, higher low. That's the half signal I was talking about. But here's the thing you have to watch out for, Mike. You're at a resistance area, right in this area right here. You see this high from back here on, what is that, the 9th of June? That's going to be your worst enemy at this particular point because you have a stock that is at a resistance point with dropping volume. See that dropping volume? If a stock is going to break out over resistance, it needs volume to push it over resistance. Think of that resistance as a brick wall. You need momentum. You need volume to push it through. If the buyers are fizzling out after just seeing a fairly new bearish engulfing pattern on lower volume, you got to be really careful. So what I would do is I would put my stop below today's low because you have a slight gap down here. Very slight, but that's a gap that could act as a price magnet before it rallies. You see? So this, I'm more inclined to think it's going to go fill that gap before it goes higher and breaks out over resistance. All right? And then if you look at the weekly chart on this one, the chance you might see a double top on this one forming too. Yeah, that's a big. This could very well be an M top in the making. So this weekly chart, I mean, if I were in a long position with this and I was faced with taking a profit, I would do one of three things. I would either sell half the position and stop the rest. I would sell in the money calls in the front month to give myself some downside protection, right? Or I might sell out of the whole thing. I mean, when you see a double top like this, you have a wide divergence on the weekly chart from that moving average. And it looks as though in the past, every single time this stock is pulled that far away from that moving average, you pull back to it. So that's a big caution flag I'm waving at you. That might be careful, that one. Okay. Sutash, I hope I'm pronouncing your name. Forgive me if I messed that up. JPM, what's your position on this one? Here's a weekly chart on JP Morgan. And let's see, let's go to the daily chart on that. What's your position? Let's see if I can find that. I know there's a little bit of a delay, but if you could tell me what your position is, that would really help me help you better. Okay. All right. Well, let's see. JP Morgan, you've got a red candle bearish engulfing pattern here, a lower low, lower high. The only good thing you got going right here on that is that you had a drop in volume as the stock is going lower, and it's at a support level. You see that? So that would be a stock on support with dropping volume would be bullish. Again, looking at the trading checklist, you got a it's more or less a spinning top at support on lower volume. Lower volume is bullish. Okay. There is a divergence from the 20-period moving average. However, it's not a very wide divergence, but the fact is the divergence is bullish. You got the stochastics is bullish because it's extremely oversold, and the PCI is not quite oversold, but getting there. I would say out of all of them, keep an eye on the CCI because that's probably going to make the first turn before stochastics, okay? Hopefully I'll help you out. All right, Dylan is asking me if I can look at DAL. Now, we have a position in Delta Airlines. We have a calendar spread on this. And one of our students and I were having a conversation. This is what I think Delta is going to do. Dylan, I don't know if this is going to help you. I think Delta is going to go up. I think it's going to go down and go up again. There we go. It's stuck. It's basically stuck in range. Now, the option traders, many of the option traders that subscribe to my alert service, long the $20 calls, some still short the $30 calls. So this little spinning top, believe it or not, after a bearish engulfing pattern on lower volume, slightly lower volume, that spinning top is a sign of indecision. It's actually bullish, more bullish than bearish. It's not extremely bullish, but when you have a lower candle, a lower low, lower high on lower volume, that tells us the sellers are losing momentum. The stochastics is starting to hinge sideways. That would be bullish. This is not bullish, the CCI. So the majority of the signals are showing bullish with the exception of the CCI. It's not oversold. It's not overbought. It's not even turning yet. So that's the only thing that you got to watch out for on that, Dylan. Okay? All right, Joan, if anyone has any questions in addition to what we're doing here on the stocks, ask away. Joan has a question on CARR. Has a long, actually not a question, just a long position on CARR. Now here is an interesting pattern because everything about this one, at first glance, is looking more bullish, I should say, than bearish. You got a big green candle that is almost a bullish engulfing pattern. This stock had opened up any lower, it would have been a bullish engulfing pattern. So that's bullish. The volume does not support the bullish candle, though, Jones. So be careful, right? I don't know where your long position is, but that drop in volume today, it leaves room for caution. Okay, so what I would do if you have a long position, when you see the volume low, I would find a respectable level of support, probably right around 21, and I would put a stop below that support level, right? Now, in addition to what's going on here, we have the stochastics making an extreme hinge up, very close to a buy signal. Today, Joan, this is the biggest plus for you, all right? Today, the CCI is crossing over the black line, which is the momentum line. And you have a small gap. It's a very small sliver of a gap right there, which I would say is going to act as a resistance area. So if the stock gets up to around 23.20, you might want to protect just your position if you have any profits on that. Because 80% of the time gaps fill, but after they fill, there's an 80% chance that it reverses from that price. Okay? So be careful of that. All right, that's CARR. Okay, Francis, I see that you're also holding the 75 puts. All right, still in the front month. Be careful. All right, Laura, welcome. And I don't know if James is with you. Tell him I said hi. All right, Laura is looking at Microsoft, MSFT. Microsoft is one of the reasons why the tech sector has been storming. This is a fairly strong green candle that is reaching into new high territory, right? So that candle is bullish. That's the only thing that I see that's really bullish on Microsoft. So you got to be careful, Laura, all right? That green candle is bullish, but look at the checklist now. What am I looking at after that? I'm looking at volume. I'm looking at the moving average. I'm looking at gaps, and then I'm looking at the oscillators, aren't I? All right, so let's look at that. We see the candle's bullish. It's on a new high, but look at that. On not so great volume, that would be bearish. That's a bearish signal. These stochastics, very, very bearish. CCI, very, very bearish. Can anyone tell me why I'm over exaggerating that very, very bearish description? Can anyone tell me who is going to point this out? I've said it a couple of times on the weekly market report. I've said it many times on my negative divergence. Steve, you are good. Oh, Harold? Yeah, Todd, all of you. Yeah, look at this. Folks, if you've never looked at the CCI and this is your first time, understand this is why this one is so important. We have a stock back here that on the 10th of June hit a new high. It fell back and then today set another new high. But what's happening to the highs on the stochastics? What's happening to the highs on the CCI? That is known as a negative divergence. That out of all the signals, I've said this before, I'll say it again, of all the signals, that is the most bearish you're going to find on the chart when you have a negative divergence in the CCI. So don't be fooled by that green candle. This could be a big bull trap here, right? So you have a big green candle on lower volume, wide divergence from that moving average. You got a gap below the market that'll act as the price magnet, okay? You got the stochastic showing a negative divergence. You got the CCI showing a negative divergence. This is what I think is going to happen with Microsoft, and I'm going to leave that line up there. I think it's going to pull right back. I'm going to make this a little bit longer. I think Microsoft is going to pull right back to fill the gap, just like that. It might even do it a little bit faster than what I've drawn here. So I don't know, Laura, what you're doing with that one, but we can talk about that sometime this week. Okay, Harold, looking at GLD. GLD is the Gold Trust ETF. This one has broken out into new highs. We, by the way, I'm going to go back to this. Our subscribers took a long position last week in UDN. UDN is the bearish dollar ETF. So for those of you who subscribe to my trade alert service, we bought this one at $20.28. It's up a little bit, but we got a full pivot point here today. As I said, the stochastics will probably start turning up, and I said that the CCI will probably turn up. Remember, this is from our report, folks, for those of you who subscribe. The dollar is starting to move down. Gold is going up, right? They're not always inversely related, and they're not always directly related, but when you have gold reaching into a new high here, you have to keep an eye on two things: the type of candle and the volume. Now, here's what I think is going to happen, Harold. I don't know what your position is, but you have to keep a tight stop on this. Why? I'm going to let the audience tell you why. Okay, folks, look at the volume bars here. What is that called? Who wants to be the first one? What is that called? Bum, bum, bum. Tick tock, tick tock, tick tock. We have a little bit of a delay there. Who wants to tell me what that is? Oh, no, doji. Well, yeah, the candle is doji, but looking at the volume, Steve got it first. Stale green light. We have 6 green candles in a row here. When was the last time we had 6 green candles in a row? 1, 2, 3, 4. It's 5. I got to back up a little. I don't know. It's been a really long time. Here's one. 1, 2, 3, 4, 5, 6. We had 7 green candles in a row. Right here, this was the 7th green candle back here in February, and then gold tanked, right? What do we have? 6 green candles in a row with the doji. That's very close to an evening star. That's bearish. Look, see this doji back here? Look at the comparison to the doji back here. See the comparison? Wide divergence from the moving average, gap below the market. We have a lower volume day, although it's slight. Lower volume day today than Friday on that little spinning top doji. Stochastics are extremely overbought. CCI extremely overbought. If I had that position, I'd be selling it. But that's up to you. I'm not going to tell you what to do. At the very least, put some stops on there. All right, protect any profits that you might have, and hopefully you're going to have a good time of that. All right, Harold. All right. Earnings on Friday are very weak. Okay, Francis was talking about that other position. Okay, Todd, let's look at Apple, AAPL. You know, Apple, these are old. I'm just going to erase this. So Apple is also in a, using the checklist, you got a strong green candle there, almost no shadows. All right, it's almost Harabuso. No shadows, but that does have a slight shadow of at the top. The drop in volume is significant. That means the buyers are losing momentum, Todd. Okay. All right. You're looking for a 395 to 400 point. I don't know about that price target. That's pretty aggressive. It might hit it eventually. But that drop in volume with a wide divergence in the moving tells me this one might want to pull back. The CCI is now overbought. As soon as that CCI crosses back down below the red, it's a sell signal. I should be really, really careful about that one. And what you could do, I don't know if you have stock or you have an option in it. I don't see, but time duration is 1 month or more. Let's look at the weekly chart on this one. It's going to look a lot different than the daily. It's even going to look a little bit more overbought than the daily. But look at that. See this? Look at that. Here we go. Look at this is a weekly chart. The stock was hitting higher highs all the way down. Look what's happening to the CCI. Lower highs all the way down. I don't know. I would take the opposite side of that position for sure. That's a wide divergence in the moving average. You got a long stretch of green on the weekly candles. You got drop in volume, although this is only Monday. We have to see how the end of this week pans out for volume. But this is a 3-year chart. That is probably the most overbought over that moving average that we've had. That's the widest divergence it's had in 3 years. So be really, really careful. Here's the other thing. All right, I don't want to beat the dead horse here, Todd, but I'm trying to protect you. When you have an angle like this, remember we talked about speed. We talked about fan lines. Here is a sideways to slightly upward move. Then what happened? You take the last line in that and you connect the next lows. Then you take the last touch and you go more vertical. You see, we have the angle at which the stock is accelerating upward is becoming increasingly steep. Stocks cannot sustain vertical price action forever. So that tells me be more defensive than you ever have on that position, right? Because if I go back to the daily chart, you can even see that the speed line even continues almost in a fourth more vertical line. So when I use speed lines like this, the most, I guess you can see most vertical speed line, which would be this most recent one, is where you would put your stop. because once the stock starts breaking down below the speed lines, it progressively starts breaking down to the next speed line in the sequence. All right. So hopefully that will help you. I'm looking at the clock. We are out of time. But again, special thanks to those who are joining us for the first time. When you get to the recording on YouTube, please hit the subscribe button. Please hit the like button. Please share it with everyone that you know. This, of course, is the longer of the reports that I do. The weekly reports are usually a lot less, maybe 7 to 10 minutes, but they are valuable, and the markets are trading more technical than ever before. I hope you appreciate that. Okay, thank you, folks. Have a good evening. We'll talk to you soon. So long.
This video segment is a small part of what the market guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.